Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Welcome back to another episode of Zen and the Art of Real Estate Investing. My guest today is Paul Moore. You're going to hear the books that he's written and his background shortly, but what he does at Wellings Capital is invest in historically recession-resistant asset types. These are carefully vetted investments that provide immediate diversification through their funds. This is a private equity and syndication show. Let's go. This is episode 240 of Zen and the Art of Real Estate Investing with my guest, Paul Moore. Paul is the founder and managing partner of Wellings Capital. They are a real estate private equity firm that provides accredited investors with access to a diversified portfolio of recession-resistant assets, self-storage, manufactured housing, multifamily, light industrial, and more. Paul is also the author of the book, Storing Up Profits and the Perfect Investment. Paul, welcome to the show.
Great to be here, Jonathan. Thank you.
Yeah, I'm excited to talk to you and get your expertise, which is really varied. But I want to start with something really interesting that I read in the forum that you sent me and something that I've believed in for so long. Why is the word no so important as investors and also to you guys at Wellings?
You know, I sold my company in 1997 to a small public firm, and my investing mantra after that was, yes. It has to prove itself really hard for me to say no. And even then, I might still say yes. And, you know, I wasn't an investor at all, Jonathan. I thought I was. I was actually a speculator.
Ooh, yeah.
And I was disguising myself, lying to myself that I was an investor. That was back in 97, 98, 99, and after that, if I can admit it. And so I made a ton of mistakes doing that. And later, I discovered people like Warren Buffett, who specifically said, let me get the quote right. He said, the best investors say no a lot. The very best investors say no almost all the time.
Yeah.
And so it is critical to have a default of saying no and to make something absolutely jump through hoops, cross every hurdle and say, prove itself to say yes. In fact, our company reviewed 745 operators and deals last year for our fund, and we said no to 740 of them, which is 99.3%. Yeah. And that was very expensive. It was painful. We have one that we already have taken a deposit for, and I just got word an hour ago that it's almost certainly dead in the water. That means our whole team has to go find another deal today. Yeah. And in the next couple of weeks. And so it's painful, but it's important because so many deals, there are so many deals available. I'll say that. And it's so easy to say yes, just out of convenience, especially if you're a busy professional.
Yeah,
a lot of our
investors
are doctors, dentists, IT professionals who just want to, wire money and move on. And it's just critical that you just take the time to have a default of saying no.
Yeah, I completely agree. I've always said that the biggest power for real estate investors, just in any context, is the ability to say no, walk away from something. And it's become even harder because you had that trouble in 1997 by saying yes. But now with like the internet and everything being AI, everything looks good. I mean, no deal looks bad. It's impossible to see something that's not shiny. Right. So I understand why investors really need this advice now and need to go to this slower approach. Like you said, these Warren Buffett principles. How did those become so important to you over the years?
Well, I had a podcast for 4 years called How to Lose Money. And it was a wealth building podcast. We had 238 episodes, so you're ahead of us. But on there, we just heard painful story after painful story of people that said yes, people that rushed in, people that chased shiny objects, FOMO. And I was all that myself. And so when I discovered Warren Buffett and realized that he had a better way of going forward, I just jumped on it and studied all I could. Warren Buffett was asked by Jeff Bezos, Amazon, of course. Bezos said, Warren, your approach isn't that complicated. Why doesn't everybody just imitate you? Buffett said, nah, nobody wants to get rich slowly.
Yeah.
And Buffett, now listen to this stat. It's hard to believe, but people should go research this to see if I'm right. Berkshire Hathaway could lose 99% of its value. That means for every $100, it could lose 99 of 100 and still wallop the S&P 500 over the last 6 decades.
Yeah.
He's probably somebody we should listen to.
Yeah. But again, it's still hard because he's not shiny. He's actually like the opposite of shiny and the opposite of what's now, quote, trending. It makes it harder for new investors. And especially, like you said, very busy, experienced professionals who have money to put into a deal. They could walk into anything. Everything can look good. How can they stop themselves from doing it? Because it's harder now. Everything looks so nice.
Yeah. I think, even going back to 99, when Warren Buffett was a mere 69 years old, he's about 94 now, and he was mocked. They whispered about him. His friends said he was washed up, and he knew what they were whispering. And he was at Sun Valley, Idaho, in their annual billionaires retreat, and they were saying, hey, he missed the boat. We made hundreds or thousands of percentage ROI on tech, and we're going to continue to, while Buffett's sitting there, like this boring old doddering fool.
Yeah.
And Buffett stood up the last day, if I recall, of the conference, and he said, I know what you're saying about me. I don't care, because I would rather invest in Wrigley's gum than in your technology stocks, because I don't know where tech will be in a decade. I know how people will be chewing gum. And of course, a year and a half later, the tech bubble burst and Buffett was proven right yet again.
Yeah. It goes to slow and steady, boring things that work. But as you said before, most people don't like boring. It's in the quote.
Right.
They want fast money. That's why people are interested in startups. But I don't think people realize when you invest in startups, if you hit it big on one, you probably lost on 99. The one just goes astronomical.
What's crazy is we try to imitate these outliers.
Right.
And Jesse Livermore was the first day trader. He made $100 million, which is, I think, $4 billion today's dollars, in October of 1929. And of course, he shorted the stock market. And, he couldn't even replicate his own success. And tragically, he took his own life 11 years later. But, we try to imitate the outliers. We try to imagine what it would be like to try to compete with Google now, or to start another Facebook, or to, somehow create a better AI. It's extremely unlikely. They've got luck and providence and timing and the right connections and money. It's much easier to do what Munger said. Charlie Munger, the most brilliant mind in the investing world, according to Bill Gates and according to Warren Buffett before he passed away 15 months ago, the most brilliant guy on the planet. You know what he did? He spent all his main efforts were spent in trying to avoid mistakes. That may sound like something just to move on and think about something else, but think about it. The most brilliant guy on the planet, investor-wise, could have been constructing extremely complicated algorithms. He could be doing this, exotic Bitcoin trading strategy, or he could be doing anything. But instead, all he did is he focused on studying other people's mistakes and avoiding them. That's pretty smart.
Yeah, look, part of podcasting, as you know from yours, is delivering information to help people not step in the same holes, especially with the name of your podcast that you did so many episodes on. Like, we're giving all the information out there. It's really hard to understand why people would take in the information and then choose to go the other way. But then there's the ego. The ego and all of the opportunity is out there. And as we both know, it's happened for me too. Ego has played a role. And especially like you said, after you sold your company, the money's there. You feel like, hey, I can make a lot of good investments. Why did you make bad investments at that time compared to what you know now?
I'll tell you why. Because I wanted to get the same thrill out of investing I got as an entrepreneur. I was bored. I had made, some money selling my company, and I got bored pretty quickly sitting at home trying to be the best father, the best husband, the best friend that I could be. That's a quote from me in 1998. And I got bored and I thought, well, I should get the same thrill out of investing that I did out of being an entrepreneur. And I became what I now call an entrepreneurial investor. I love the thrill of the chase. I love staying in startup mode all the time. I love knowing half of the information I needed to know to succeed. I love repeating the learning curve. I apparently loved having a very broad but no deep knowledge of any one subject. I apparently loved trying to hit a grand slam and striking out most of the time. And I apparently loved the prospect of eventually living in a mobile home if I hadn't changed my ways. And there's nothing wrong with living in a mobile home. No offense to anybody. But my point is, it's probably not the way most people set their aspirations on at 34 years old when they sell their company.
Yeah, and the baseball analogies, I think, work so well for investing, especially real estate investing, because the singles are boring. A lot of people just pass them by. But if you just keep the single, that single gets extreme compound interest. And that's what Buffett loves. Put it in there, hold, see what happens. That's why everybody says, the people that we're talking about say, buy real estate and wait instead of wait to buy real estate. These are principles that are all matching up with what you're saying. Did you take all that you learned and then put it into kind of the core values of Wellings when you created that company?
Yeah, when we finally created Wellings Capital, which was about a decade ago, we, the first thing I wanted to do was avoid speculation. I wanted to avoid chasing shiny objects. I brought on a partner who was just about as opposite at his age. He's now in his 30s. At his age, he was in his 20s at the time. He was opposite of what I was at that age. And that's what I wanted. I didn't love it. And if he's listening, sorry, Ben. But honestly, I didn't love the friction, the extreme conservative nature he brought. I mean, almost all the money that he and I have made as far as profits has gone into reserves just for a rainy day rather than taking it for ourselves. But it was exactly what we needed to do. And it's exactly why so I wrote a book called The Perfect Investment, which was about multifamily. I know it's a humble title. And we actually avoided multifamily. In fact, I went on dozens of podcasts and wrote dozens of blog articles for Bigger Pockets. I had a live show on Bigger Pockets, Facebook Live and Instagram Live. And we basically, I just warned everybody. I was like, time out. I was wrong. The perfect investment's not perfect. If you need to use risky floating rate debt, if you need to assume that trees, aka rents, will continue to grow till they hit the sky, if you need to assume that inflation can take your rents up but your operating costs down, if you want to believe that, and if it all has to work perfectly after overpaying 30% to buy the asset in the first place, that's not something I really want to do. So that's when we pulled out after like years of beating our head against the wall, and we became a fund that hand selects the best operators, the best projects, and the most conservative strategies we can find.
Yeah, it makes sense, though, because you can take your expertise and then be more choosy with the fund than your typical syndication, which, again, a lot of the syndications that went sour based on just what you said, this floating rate debt, bridge debt that they chose were one-off, properties, which can be exciting. I enjoy those because I like the attachment to the property, but also there's no leverage on the other side of anything against it to keep you up if something goes wrong.
Right. Yep. That's right. A lot of the deals we invest in now are acquired from mom and pop operators that are extremely undermanaged. or, that don't take advantage of so many opportunities. I wrote a blog post yesterday about one that is an RV park that had 17 year-round lots and had 80 total lots that we invested in. Well, the operator went in and with $10,000 in upgrades was able to get all 80 lots to be year-round, because this was in Ohio. So, it gets cold there. And, just looking at opportunities like that nobody, or apparently the mom and pop operators missed. And I mean, that increased the value of the park from 3.63 million to, it increased the value by 2.1 million to over like 5.7 million. And that was just almost within months. That's a huge upgrade. And what it does in the Buffett mindset, it increases the margin of safety between, you and the lender. Well, there was no lender. It was a cash deal. Now they can go out and get debt on it and redeploy that cash somewhere else into yet another deal, which is a Buffett way of thinking as well.
Yeah, I mean, that's just smart investing and figuring out what assets are going to work. There are a lot of opportunities out there that are operationally in trouble. The asset is actually okay, but like you said, that those small operators just get out over their skis all the time, where they get too comfortable and then realize later, wow, this is really getting away from me. I need to get rid of this. Is that some of the types that really are interest to you, because you can turn around them and get that big value increase without a bunch of value add?
Yeah, that would be an interest to us. We haven't seen a lot of those deals that have been going back to the bank yet. We are super operator centric. So, Buffett has, 108 management teams that he's invested heavily in, and he really believes heavily in them. And then, of course, they do the heavy lifting. Well, the operators we've invested in, there's only been a little over 20. They haven't been coming across those amazing deals that have gone back to the bank. However, one of them, and this is hard to believe even to me, and we're doing the deal, but we're closing on it next Monday. It's a $51 million acquisition, but it's appraised by a third party at $65 million. So creating a $14 million margin of safety there.
Yeah.
But there's $30 million in debt and $21 million in equity. We're bringing 15 of that 21, and that'll put us in a priority place in the capital stack, because it'll be preferred equity essentially. Yeah. And here's the crazy thing. You might think this is a distressed property. It might be, coming back from the bank. No, it's a very, very large multi-billion-dollar REIT that's selling it, and they had to close out their fund. They were very pressed for time, so they took a lower price from somebody they knew who could get across the finish line, and that was one of our operating partners.
Yeah, and that goes to the relationships that are built in this field, which I think that your brand new investors are used to just dealing with, one-offs and regular realtors. It's a whole different ballgame the higher you go. Operators and relationships are the things that get things done in these scale. No new person's walking into this deal and saying hey, I'd like to get that. Here's my pre-approval. It doesn't work like that, right?
Right. Yeah, the barriers to entry against most people getting involved in commercial real estate are really high. But to the point of our conversation before the show started, we can access those deals through syndication. It's just finding the right operators and doing the due diligence and trusting them to do the heavy lifting.
Yeah. Well, so when you're looking at operators, I know you said that it's really only about 20. What's the most important thing you want to see from an operator when you want to start with them, when you haven't done business with them before?
Well, we have a 27-point due diligence checklist. And, I am not sure I can answer that, because there are so many important things. You would think that, maybe the criminal check and the background check and the reference check would be most important, Jonathan. But if those all are perfect, yet they're using risky floating rate debt, we'll walk away.
Yeah.
And if they're using the right kind of debt, we might walk away because we found out that they didn't tell us the truth about something. We do an NOI audit. And when we do the net operating income audit, we might find something drastically different than they told us. And so we'll walk away because they didn't tell us the truth. We'll walk away based on a gut check. Everything looks good, but we went to visit them in person and just had a funny feeling that there was something wrong. We might walk away for that. So it's hard to say.
Yeah, and it becomes even more important when you're caretaking other people's money as part of the deal. When it's you or when it's me, we can make mistakes and you can kind of assess your own willingness to take a risk. But once other people are investing in you, you need those 27 points to assure that they're going to be safe as well. That's
exactly right. And that, if anything would ever keep me up at night, it would be, using other people's money. I was $2.5 million in debt in 2007 on the eve of the great financial crisis. And I never lost any sleep that I remember over that. I was debt-free 13 months later, by the way. It was a crazy story.
Yeah.
But if it would have been other people's money, I don't know how I could have done it.
Yeah. And I think that's what people really need to look out for, because you when you're giving money, even if you're the quote low totem pole for accredited investors at $50,000, you still want to make sure, like you said, that gut check is really important. Even if you don't know anything, that gut check, do I feel safe handing $50,000 of my money to this person if they can't answer my questions, or they're just, not the docs don't look as good, or you ask one question and it doesn't really work out. Yeah. It's really important to know that yourself and not do what we both did. Is like, wow, this deal looks good. Let me get to have that, have one of these. That will set you into a bad precedent.
Yeah, for sure.
Hey, it's Jonathan. I hope you're enjoying this episode with Paul Moore. If you want to get more information about how you can get invested with Wellings Capital, go to wellingscapital.com/investments, because this will give you track record. And I'm sure we talk about it during the episode that track record is so important. You can see all the funds that they've closed and open funds that they have. Let's get back to Paul. Of all the assets, is there an asset class that you prefer right now in today's economic environment?
Warren and Charlie claim that they never had a significant conversation about the economy once in 55, 60 years of investing together when they made a decision. So I like to look for asset types that are not dependent on the economy, although that's important too.
Yeah.
We like mobile home parks, and they're not sexy. They're not exciting. They're something that everybody looked down their nose on for years.
Yeah.
But honestly, it's the only asset type I know of, Jonathan, that has decreasing supply and increasing demand every year. There really is an affordable housing crisis. 10,000 people turned 65 today.
Yeah.
And 6,000 of the 10,000 don't even have $10,000 in cash in savings. And a lot of them can afford a mobile home lot rent and would actually prefer to live in a mobile home park where they get their own yard, their own front porch, their own, parking spaces, as opposed to an apartment where they have to share a thin wall with somebody. So mobile home parks are an incredible asset type, and I think that they will continue to be for a long time.
Yeah, they've just always had, a bad and uncomfortable reputation, which is not correct when you're an operator in the space. You really see them as different, but they just go back to what everybody thought, that everything that was a mobile home park was bad, when there's very luxe mobile home parks out there that you wouldn't ever think, oh, that's a trailer park, even though that was the connotation. Is still the same thing.
Yes, right.
Yeah. It's interesting, though, what public perception can do for investors. Do you get any, when you save for somebody new, you probably don't really need new investors at Wellings because of your reputation. But have you ever had to pitch someone on the value of mobile home parks because of that overall reputation over the years that they couldn't be a great asset?
White Coat Investor, which is a large medical doctor investing community, invited us to work with them, and they invited me to do a blog post, my first blog post with them in July or August of 22. was about the beauties of investing in mobile home parks. And we got kind of slaughtered by some doctors who were saying, you're taking advantage of the poor and all this. And Jim Dolly, the founder and leader of White Coat Investor, jumped in and he just jumped on these doctors. He's like, are you kidding? You're charging these people hundreds of dollars for a 10-minute appointment.
Yeah.
And you're telling me that they're taking advantage of people. And so, that was the only time that's ever really happened. I imagine there have been times, Jonathan, that somebody didn't invest with us and didn't tell us, but that's the only time that I actually felt super defensive. And I actually wrote, kind of an article, or not an article, but a defense of what I said. And I've been pretty careful since then about where I say that, though, because there are still some people out there that I know would just assume that you're out, you're up to no good. Even when you're increasing their quality of life, you're paving these gravel roads, you're putting in playgrounds, you're doing all kinds of amenity increases at these parks. You're going to have people who make bad assumptions anyway.
Yeah, I think there is this weird tenet out there that investors are all bad and it's profits only, and there's no way that you could actually earn profits and be socially conscious, which we all know, of course, is possible and is done much more these days, where you're putting out things. That's been important for you guys at Wellings also, to make sure that you're being socially conscious and taking money and contributing to other things that make a difference in the world. Am I right about that?
That's absolutely true. One of my heroes in history is William Wilberforce. He lived from about 1780 to about 1770. And he, among many, many other amazing accomplishments, he actually had the slave trade outlawed after about 20 years in Parliament, I believe. And then 3 days before he passed away, slavery in general was outlawed in the UK, and that spilled over, of course, to the United States and other countries, thank God. Well, Wilberforce, 200 years later, sadly, we have more enslaved individuals than any time in world history, at about 49 to 50 million. Since you and I started talking, hundreds of children have been captured or sold into slavery, and it's a tragedy. Wellings Capital is doing everything we can to try to tell the world about this and try to raise awareness. One thing we tell people is that if you took the record, not the average, the record profits of ExxonMobil, Nike, and Walmart, added those record profits together, tripled that number, that's the approximate profits of human trafficking every year.
Yeah.
And it's a true tragedy. And so we've raised, it seems like a drop in the bucket, but we've raised about $840,000 so far since 2021. And we continue to try to do that for our partner, which is AIM, AIM, aimfree.org. And we encourage people to go check out their amazing work in Cambodia and Belize.
Yeah, that's fantastic. And I think it gives another part of the vision that you can take things and put them there. But even going back to what you said about upgrading just the living conditions is a big boost for somebody. Somehow this rhetoric got out about all landlords being slumlords. And it was always crazy to me because I grew up with a dad who was a landlord who would just freely let people not pay their rent for 6 months and then tell me to go collect it. So I never really saw it as the public perception. But it goes to a lot of the things that we're talking about. What we may see in the news, of course, is going to be extreme either end. It's not really a full picture of what long-term real estate investors are doing, because a lot of them aren't on social media.
Yeah. Yes, it is true. There's, and there, let's face it, there are some that give everybody a bad name. And that's, honestly, Jonathan, I hadn't thought of this before, but that's some of the deals we buy. In other words, our operating partners, we're not the operator, but our partners, they buy those deals. And so here's a recent example. I think this was in Iowa. Our operating partner acquired a mobile home park, and they immediately started paving the roads, and the residents brought them a huge cake thanking them for buying the park, even though they did raise those lot rents as well because they were way below market. And so it's possible, like you said, it's possible to do both.
Yeah, but I mean, if you look at multifamily and if you upgrade all of the units and you add more amenities, people are going to be fine paying for that for the most part because you've made the community stronger. And when you go from bad management, whether it be an RV park, self-storage, multifamily, to good management that clearly cares more, the residents aren't really going to put up. It's you just, no one likes paying bad rent. Even if you're paying under market rent, there's a reason for that.
Yeah, right.
Because you wouldn't need to if it could go up. There's a reason why you get stuck in that position.
Yeah, absolutely.
Yeah. Do you guys prefer those type of investments, or do you also do heavy value add through the operators that you work with? Because those are a longer pay scale, so it's a different money investment in terms of what the return is.
Yeah, so this one I mentioned that was $51 million, because it's a big institutional player, there's hardly any value add to do there.
Yeah.
They're putting in a few $1 million and expecting, just a very moderate bump in rent, $70 or $80 on the units they're upgrading. But then there are other properties, like one south of Atlanta, that was, trashed. Or I'm thinking of one in Chicago where there were boarded up, windows and things. And they're very high value adds. And of course, we take a lot of precaution when we're investing in something like that. We're going with operators who have a long track record of successfully doing these projects over and over and over.
Yeah.
And so, but yeah, we do both. We don't generally do core assets, which, where everything is done and all you're doing is banking on rent increases from inflation. We feel like that is actually sometimes riskier, because if you look at, there's so many examples we could use, deals that were, where there was no meat on the bone, no value add, no upside, and therefore no ability to create a margin of safety, which is a huge Buffett thing to do.
Yeah. And I mean, like you said, the deal, the 51 million, you're walking into 14 mil of equity. And I mean, that is your margin of safety.
Yeah.
But that's also an important thing when you're dealing again with investors. That sounds good. And it's also real, as opposed to making something look good and then not being able to back it up.
Right. Yeah, I don't know if you heard this, but when we were talking to syndicators, we would hear things like, "Oh, rents in Tucson have gone up 12% a year for 3 years. We're only assuming 9% a year for the next 5." Like, wait a minute, that might not be the best idea.
Yeah. Yeah. Again, though, the busy professional just looks at it and it sounds good. And it really, we can all look at it in a while. If it's like that, it seems good. And if you're new to the game, you really don't have a way to ask the right questions. Is there a way that people can kind of get on that? We always point people to books and podcasts that they can listen to. You obviously have your own 27-point due diligence for a deal. But for somebody who's a busy professional, high earner, what should they be doing to make sure that they're investing in the right syndication or fund? Because I think that is going to be more attractive to people now who may choose to be high-end earners. They may actually choose to rent. I just believe this going forward. They may not see home ownership the same, but they have plenty of money to deploy into investments.
Right. It reminds me of that song. I hadn't thought of this in a long time. Paul Simon had a song, or it could have been Simon and Garfunkel, The Boxer. He said, "Every man believes what he wants to believe and disregards the rest." And that's what happens when you look at a shiny object. You believe that Tucson rent story because you want to. And you disregard the Jonathan or Paul who will say, "Hold on, that doesn't make sense." Well, yeah, that guy's just a naysayer.
Yeah.
It's just like when we look at reviews of a hotel or we really want to stay at, or a car we really want to buy, the red convertible, right?
Yeah.
We disregard all the bad reviews. Oh, the oil leaks. Sure, the oil leaks. That guy's just a complainer.
Yeah.
But anyway, I'm looking for a car right now, so that's top of mind.
Yeah.
And I'm not looking for a red convertible, though I might end up with one.
Yeah.
In all seriousness, there are places you can go now. So you probably know this, but your listeners might not. Ian Ippolito sold his tech company in 2012 or 13, and he was trying to invest in alts and specifically in real estate syndications. And he realized there wasn't a place to get good reviews. So he started the real estate crowdfunding review. And later it developed into, basically reviews of all syndicators and funds, especially in the real estate space. And now he's got what's called the Private Investor Club. And of course, I'm not here to promote that, but I'll tell you that from what I've heard, and I can't, Jonathan, you may be able to join that club and look it up. But I can't, because as a syndicator or fund manager, I'm very specifically and expressly prohibited from being on there unless I wanted to go in and, under a fake identity, which I would never do. But from what I've heard from my investors, it's very, very thorough. And there's a critical mass of investors on there to where you can actually, sort of like Consumer Reports, there's a critical mass of reviews to where you can actually get a really good answer on if somebody's done a good or bad job. The problem with it is, Warren Buffett talks about the circle of competence. There's another circle out there, and I'm trying to remember what my friend calls it. I'll have to think about what he calls it, but it's another type of circle where basically everybody assumes somebody else has done the due diligence. So I'm investing because they did, and then the circle goes on. I'm investing because they did. I'm investing because... Anyway, that can happen on those. And if you really look back at the source to see who did the really, really deep dive, robust due diligence, the site visits, the NOI audits, all the things that need to be done, nobody ever did. So that's the risk. However, honestly, I think you can get a lot of information from those, especially on someone who's doing a bad job and their investors hate them. You can find that out pretty quickly.
Yeah, I mean, the internet is helpful in so many ways, maybe not in so many as well, but it's very hard to make a lot of mistakes and not to be found out about. Especially, I mean, haven't you realized over the years from the time you started to now that the real estate investor community, it's big, but it's much smaller than people really think. Things get around pretty quickly. More people who know each other quickly. So if you're a participant and you have the time to engage in that, make sure you're going to conference, meeting people, you're much more likely to get that kind of insider information than somebody who just pops in and requests a PDF.
Yeah, absolutely. That's true. And I still, even with that, I still recommend that people go meet the parties in person. I mean, isn't it worth a $1,200, round trip ticket to meet somebody you're about to write a check for $100,000 to? I think it's worth it. Yet, honestly, of course we do it because we're doing it for investors, but so few people really make those site visits.
Yeah. I mean, you had mentioned FOMO in the beginning, and I think that's a really big part of it. When you're busy, it's easy to see, oh, well, my friend is crushing it with investments. I'll get, a 3-family or something. And then they don't realize I don't have time to manage this. So then they back out and they end up with, oh, well, passive investing sounds great. Again, somebody sends them something that looks good and they're like, oh, yeah, let's just do it, because they don't have time for due diligence. So it is a little bit of a conundrum for a busy person, no matter how much they're making, on how to build the time to do the due diligence and who to trust.
Right. And that's why we exist.
Yeah. Explain the private equity for somebody who may be newer to it, because as you were saying, you're taking in capital and then you're investing with other operators. We've had a lot of just traditional, either property syndicators on, we've had fund of funds, we've had family offices, but explain the private equity setup and what investors get through you guys. I think that will help them understand how it works.
Yeah, Jonathan, I don't know how many of your viewer or listeners are actually watching this, but for the few those that are, I don't know what percentage, but this is a graph showing the 80-20 rule. It's also called the Pareto curve or the skew curve. And this is success and margin of safety over here. Yeah. And this is operator or deal down here, on the y-axis, on the x-axis, excuse me. So the average investor will invest with the average operator in the average deal, and then on the y-axis, they'll get average results. Yeah. Our theory is because the curve, for those who aren't watching, goes up and to the right in a skewed manner, excuse me. I'm trying to multitask here and trying to do this in reverse. Yeah, it's working on video, so don't worry about it. Okay, good. Yeah. So if you invest in the top 20%, or better yet, the top 20% of the top 20, in other words, the top 4%. Yeah. you will be like, your results will be much, much better. I'm not going to say they're 4 times better as this graph looks like, but they're much, much better than the average. And by being much better than the average, they're going to be much safer when the tide goes out. The rising tide lifted all boats from 2012 to 2022. But Warren Buffett, as he's often said someday that tide's going to go out, and then we'll see who's skinny dipping. And then, of course, the 11 interest rate hikes in 16 months were not a problem, but they indicated the problem. In other words, they showed who was skinny dipping, because all the people who were using risky floating rate debt and assuming that trees grow to the sky and all that stuff, they were all exposed. And that was really tragic. So what we did is we thought, well before that happened, years before that happened, we designed a company that said, we're going to try to find, if we can, there's no guarantee we can succeed, but we're going to try to find those operators who are in that top 20%, or better yet, the top 20 of the top 20, the top 4%. And by doing that, stay way above that tide when it goes out. And so far, we've had a lot of success with that. 73% of our investments in 2024 were from repeat investors. So that made us pretty happy.
Yeah. So if somebody comes and they invest with you, do they invest and get a dedicated return, or do they get that also from the deals that you invest in?
So we're actually, all the returns are going to be from what we invest in. And so if everything goes well, everything won't always go well. That's one of the reasons we like a diversified fund. We're diversified across different asset types, geographies, best-in-class operators. We're diversified across different positions in the capital stack, different strategies. But if most of the things go well, the investors should do really well. And most importantly to us, they should have safety of principal.
Yeah, but that's the diversification of a fund, or being opportunistic and saying like, hey, we can spread this out. So if one part of the industry isn't going as well, we're backed up by another part that does, and you balance the whole fund against each other, right? That's the beauty in diversity. It's why I like index funds in general, just because I don't have to worry about it. Like, I just know, it'll come and go. It's going to go up, it's going to go down, but I'm just going to watch it do its thing, because they're going to be repurposing when things go down so that there's a better upside later.
Yeah, exactly. That's, it's sort of a mutual fund of handpicked private real estate investments is what it is.
Yeah. Well, since you wrote the book, Storing Up Profits, I wanted to get your current take on the self-storage industry. I've always found it to be pretty recession resistant. Do you still feel like it's that? I know we talked a lot about mobile home parks, but how's self-storage stack up to that as well?
Yeah, self-storage, when I wrote the book in 2019, then the pandemic hit, and then so they delayed it till 2021 to publish it. And I'm so glad they did, because self-storage in that 2 years just absolutely skyrocketed.
Unbelievable. Yeah.
Yeah. But it also meant that there were self-storage facilities being built everywhere. And it also meant that, as we all could see happening, that one day it would be overcrowded. And so while there are certain locations, so I could take you to Nashville, for example, and drive you around the city and show you why it's overbuilt. But I could take you south of Nashville to little communities like Bellevue and others where there have been huge restrictions on building self-storage, and show you why it's undersupplied. And so, just like anything else we talked about, not depending on the economy to make your decisions like Buffett. In the same way, we like to invest in self-storage that's not going to likely be in the path of progress and likely have a public storage or CubeSmart going in next door. So while our deal in Greenville, South Carolina, in one of the funds turned out to be somewhat mediocre, the deal in Ishpeming, Michigan, population 3,000, which was actually larger than the Greenville one, is actually booming and is incredibly profitable. And so was the one in Beeville, Texas, population 12,000. And so, self-storage and mobile home parks too are not dependent they don't necessarily do well just because it's in a big city.
Yeah.
In fact, they do really well in remote I won't say remote, but they do really well in smaller towns.
Yeah, I mean, supply and demand principles. That's really interesting, though, because if you say Greenville, South Carolina, most people know it. It's like investing hotbed for residential as well. But then the other two cities, I've never heard of either of them, but you're making it work. So that's an interesting investment strategy, because there are a lot of bigger groups who are just focused on towns that everybody knows, because, again, probably easier to get people to invest in, say, Chicago than Ishpeming.
Yeah, right.
Yeah, so I mean, that's really smart, and I think that's really helpful to people. Do you think it's still accessible, though, for like just single operators to buy those type of smaller self-storage from those mom and pops who can't handle it? Because maybe those markets are still ripe if they're good at operations.
Yeah. We have one of our operating partners, I can't remember if I mentioned this already, has 8 people sitting in a large room 40 hours a week, texting, emailing, calling, messaging, tens of thousands of operators in self-storage, mobile home parks, and RV parks. And they're mostly mom and pop operators. And I'm not saying that they can do this consistently, but their goal is to contact all the ones they'd like to buy about quarterly. Yeah. And so when they call that operator in April of 2025, they may not have been interested in January, but in April, suddenly they have a health crisis, or they just decide they want to retire or whatever. And they say, yeah, you're the person that I want to sell it to because you consistently called me for 7 years. Yeah. And that's a real example I just gave you there, by the way. Yeah. It was actually 8 years, the one I'm thinking of. And they already have built-in trust because they've been contacting them so regularly. And that example I just gave you was actually somebody who was 95 years old. They had been in contact with them since they were 87 or 88 years old, if I recall. So when you are doing a strategy like that, and when there are tens of thousands of mom and pop owners out there, as there are in all 3 of those asset types, it's very possible. Now, if you tried that same strategy in multifamily, it would be almost impossible because there are so few multifamilies that haven't already been value added and haven't already been picked over.
Yeah, that makes a lot of sense. I mean, if you're just driving around a regular, more rural area, you see random self-storage still everywhere. I mean, I'm always on the lookout for it, and you're like, oh, look at that, 12 bays. I wonder what's going on there. It's like the type of asset that you pull over to try to get the number, and you can't even find them on the internet. But if
I know, I called one. I went to Fairbanks, Alaska to look at a mobile home park. By the way, it had, listen to this. Somebody bought a sand and gravel pit, and it had a huge lake that was created by the sand and gravel operation. Yeah. And by the way, it just happened to have 211 mobile home park spaces around the lake. And they're like, I don't want to be a mobile home park operator. And they sold it for like a 25 cap. Yeah. And I happened to be on the buying side of that. Yeah. And that was great. But there was a self-storage facility across the street. This was my point. And I called the number on it, and it was a voicemail that said something like, this is Jeannie's mobile massage. And if I'm not picking up, it's probably because I'm out of service. Call me on Wednesdays or something. That was the number on the self-storage sign. Yeah. And just cracked me up. And you might ask, well, why would anybody in their right mind buy 12 units? Well, here's why. Because they might say, oh, by the way, we have 10 acres out back we're not using. Yeah. And that might be a perfect spot to put in boat storage, RV storage, heavy or light equipment storage, or maybe even build a self-storage facility on. And that is a golden opportunity. Yeah. Yeah. I love it. That's just great advice to top it off. And I think that's just being opportunistic. Like you said, you're out there, you're looking around. If you're going out there to look at a big investment, you should be looking at everything around there. But because there may be other opportunities that you can do off of that. Like you said, hey, this looks great for the mobile home park. Those are going to be small. So storage is going to be important for them nearby. Just makes sense overall. Yeah, it really does. I never got hold of Jeannie either. She never called me back. She did a lot of massages. She must. She was a traveling massage. So I don't know. I guess around Alaska, they don't have that great a cell service.
Yeah. Unbelievable. Well, I really appreciate you coming on, Paul. Where's the best place for people to get in touch with you? Is it at wellingscapital.com?
Yeah, wellingscapital.com. And if anybody is interested in a free special report on self-storage or mobile home parks or just investing passively in general, they can go to wellingscapital.com/resources.
Yeah, awesome. Well, I really appreciate it. It was great having you on the show and great to talk to an investor who's been in the game a while and has played around with a lot of different asset classes and now does it to make sure that others stay safe. So thanks so much for spending the time.
Yeah, thank you so much. I appreciate it, Jonathan. I just want to say it, and I hope your audience already knows this, but you are one of the best interviewers I have ever seen on a podcast. So I'm sure your audience appreciates that too.
Oh, well, I really appreciate it. I honestly just love talking about real estate. It's like someone would say, like, why do you do the podcast? I'm like, I can talk to people that I wouldn't be able to just walk up to one day, get to know them, give great information that people can hear in their car, remain friends, do deals with later. I mean, there's no loss in it. I just love it. And real estate, again, I grew up with a dad who was an investor and he ingrained all this stuff in me. And now I'm just kind of carrying on his legacy by talking about it so much. Yeah, but I really appreciate the kind words. It's much appreciated.
You bet.
Yeah.
All right.
Thanks,
Jonathan.
Absolutely. That was Paul Moore. You can find him again at wellingscapital.com. I'm Jonathan Green. We'll see you next episode. Thanks for sticking around to the end so you can get a preview of who's coming up on the next episode of Zen and the Art of Real Estate Investing. And it's Laura Navaquin on episode 241. She's going to talk about learning how to build wealth and passive income through real estate because that's what she did. Now, this is hands-on experience, proven practices through years of her own experimentation to get where she is now. We'll see you next episode with Laura.